Hello everyone, welcome to the Stock Trading Tutor channel. If you'd like to create a free Demat account, click the link in the description and fill out your details. In this video, we'll be talking about the basic options terminology and all the words and the jargons that are used when you're trading in options contracts. First, let's see what an option is. An option is a contract that gives the buyer the right but not the obligation to buy or sell an underlying asset at a specific price on or before a certain date. An option, just like a stock or a bond, is a security. It is also a binding contract with strictly defined terms and properties. Here are some of the basic terminology that we'll be covering in this video. Strike price, underlying price, exercising of an options contract, options expiry, options premium, and options settlement. Now let's look at strike price. Strike price is the price at which a derivative contract can be exercised. The term is mostly used to describe stock and index options. For call options, the strike price is where the security can be bought by the options buyer up till the expiration date. For put options, the strike price is the price at which the share can be sold by the options buyer. Underlying price. First, we should understand the underlying asset before we look at the underlying price. Now, underlying asset in equities is the common stock that must be delivered when a warrant is exercised or when a convertible bond or a convertible preferred share is converted to a common stock. The price of the underlying is the main factor that determines the prices of the derivative securities, warrants, and convertibles, in this case, the options contract. Options premium. An option premium is the income received by an investor who sells or writes an option contract to another party. An option premium may also be referred to as the current price of any specific options contract that has yet to expire. Now let's look at in the money and out of the money. In the money means that a call option's strike price is below the market price of the underlying asset, or that the strike price of a put option is above the market price of the underlying asset. Out of the money is the term used to describe a call option with a strike price that is higher than the market price of the underlying asset, or a put option with a strike price that is lower than the market price of the underlying asset. Now, in the money basically shows that a certain options contract is worth exercising, and out of the money shows that the certain options contract, the specific options contract, is not worth exercising. Now, exercising of an options contract. In options trading, the option holder has the right but not the obligation to buy or sell the underlying instrument at a specified price on or before a specified date in the future. Now, exercising the options contract means to put into effect the right specified in a contract. So, when an option holder exercises the option contract, then he chooses to buy or sell the underlying asset depending on the option. Options expiry. The option expiration date is the date when the contract just expires and becomes worthless and you lose the amount of money you paid for the option. If the option is in the money at the expiration date, then you would rather sell it or exercise your option. Now, option settlement. In an options trade, the buyer of the option pays the option price or the option premium. The option seller has to deposit an initial margin with the clearing member as he is exposed to unlimited losses. There are basically three types of settlement in stock option contracts: daily premium settlement, exercise settlement, and interim exercise settlement. The buyer of an option is obligated to pay the premium towards the options purchased by him in a daily premium settlement. And the seller of an option is entitled to receive the premium for the options sold by him in the same settlement. Exercise settlement. Options buyers and sellers close out their options position by an offsetting closing transaction, but a better understanding of the exercise settlement process. Interim exercise settlement. Interim exercise settlement takes place only for stock options and not for index option. An investor can exercise his in-the-money options at any time during the trading hours. Thank you for watching this video. If you like this video, hit the like button and share it if you would like to share it with your friends, and subscribe to this channel for more videos on stock market and trading. If you would like to create a free Demat account, click the link in the description and fill out your details.